Thank you very much for that, Don. And about the book club tonight, I give extra special attention to those who show up with numerous purchased copies of the book. Somehow I talk to those people more, and I tend to be a lot more interesting to them, and they're a lot more interesting to me, actually. Let me begin by saying how excited I am to be here today. It's a big deal to get to speak before the LA CFA Society. Obviously, this is one of the biggest ones, so it's flattering for me. And I want to thank Don Brown for making this happen. And I want to thank all of you for taking the time to come out. I fully understand that during the middle of the day, it's not exactly ideal. And so I will work diligently to vindicate your choice to come out and hear me talk. Now, before I get into the main part of my discussion, I do think it's important to talk about sentiment, particularly the negative sentiment. I'm very involved with other pundits. I'm very involved with my readers. They send me comments all the time. It amazes me how many people are convinced that the U.S.'s best days are behind it, that somehow we're staring at France in the rearview mirror, that we are a nation in Roman decline. I think this is a mistake of reasoning. Certainly my book argues that Americans haven't run out of energy or ideas or initiatives. What they suffer right now, in a relative sense, are government barriers to their natural desire to produce. I think it's also a mistake in terms of history, and particularly when we consider the room we're standing in or sitting in right now. It's too often forgotten that when Ronald Reagan ran for president in 1980, let me stress this is not a partisan talk. You'll soon see how little I think of both political parties. But when he ran, the mood in this country was intensely low. He won by a landslide in 1980. But one of the few voting blocks he actually lost was the block of Americans who thought that the U.S.'s problems were insurmountable. They just did not understand his optimism about the potential of this great nation. And I think we need to remember that. I think we've got so much to be optimistic about just by virtue of sitting here. And I think it's also got to be remembered how far we've come. Going back to the 1970s is a reminder that our problems today are microscopic. They're kind of rich man's problems today. And going back to the 70s, it's got to be remembered that the dollar was in free fall. And that choked off investment in new ideas. Opportunities were very slim back then. As a result of this, gasoline prices soared in the United States. That was the reason they soared in modern times. Oil's never been scarce in our lifetimes. Occasionally we devalue the dollar. Interesting about the 70s is that the political class, in its infinite unwisdom, decided to impose price controls on gasoline, and as a result they were scarce. Southern Californians knew this well. In the late 70s, it was literally illegal if your license plate ended in an odd number for you to go to the gas station on an even numbered day. Even more amazing looking back to that time is we waited in line Soviet Union style just to get gasoline, hoping there'd be gas when we got to the actual pump. Considering air travel, in the 70s it was not uncommon to be asked the question, have you ever been on a plane before? It was kind of a rich man's thing to fly in the 1970s, and it was because it was a heavily regulated industry. The Civil Aeronautics Board in Washington, D.C. planned routes for the airlines, Soviet Union style, kind of a lousy time to be in airlines. Considering something as basic as a phone call. In the 1970s, there was no such thing as the mobile phone. If you wanted to make a call, it was on a landline. If you wanted to own that landline, it was illegal. You had to rent it from the government's preferred monopoly, and if you wanted to make a call from Los Angeles to San Francisco, it was going to cost you a fortune. Considering taxation, the top tax rate in the 70s was 70%. And let's be clear, both parties thought that was the correct rate. If you were for tax cuts in the 70s, you were considered a bit nutty. Arthur Laffer famously called for reducing that rate substantially, and he was a joke to the economics profession. As Alan Greenspan said about him, I don't know anyone who seriously believes his argument. And so I mention all of this to remind you that to be negative today about the U.S.'s future is to show maybe a misunderstanding of our history. We got really dumb in the 1970s. This is small right now. And that's what my book is about. It's, first of all, I'll be honest, a middle finger to the economics profession. It should be ashamed of itself for having made what is so beautiful, so bland, and so complicated. But beyond that, what the book is about is it's a reminder that when it comes to prosperity, the answers are easy. Nothing is easier than economic growth. And so my book simply describes the 4 basic governmental barriers to prosperity, but it does so through movies, sports, and television, and famous businesses. And it does because if you can observe the world around you, you know all you'll ever need to know about economics and how economies grow. It's that simple. And so what are the 4 basics to prosperity? Well, the first one is taxes. Taxes are nothing more than a price. They're just a penalty placed on work. And so in an ideal world, you want the top rate to be as low as possible, simply because you don't want to penalize production. Within taxation, there's the capital gains tax. That is a penalty placed on investment success. There are no companies and no jobs without investment first, and so ideally you want that rate to be 0. You don't want to discourage people from saving and investing. The third tax, and this is troublesome for economists to understand because they believe in the fraudulent number that is GDP, but government spending is a tax. Governments have no resources. That's not some libertarian slogan meant to please the libertarians in the room. That's just fact. Governments can only spend what they tax or borrow from the real economy first. So when they're spending, that's John Boehner and Nancy Pelosi allocating the economy's resources over Warren Buffett's, Bill Gates, the people in this room. By definition, it's a wet blanket on economic growth. The next basic barrier is regulation. Regulation does not work. Let's be even more clear, it cannot work. If you doubt me, all you need to do is go back to 2008 to the banking sector. It was easily the most regulated in the United States, yet those charged with overseeing the banks didn't have a clue about the problems within them. Now, the obvious problem with regulation is while it cannot work, it forces businesses to spend all sorts of time and energy and human resources complying with rules rather than creating wealth for shareholders. To believe regulation works, you have to believe that those who could not get jobs in energy, pharmaceuticals, medicine, finance, banking, you name it, can somehow police those who could. Even more fanciful, you have to believe that those who didn't rate jobs in those industries somehow have a better understanding of the future of them than those actively working in it. It's a laughable presumption. To believe that regulation works, you have to believe that Occidental College could regularly beat USC or UCLA in football. But logic dictates they cannot, and we know why. The talent mismatch is too large. That's how you should view regulators. You're asking the untalented to police the talented. It fails. The third basic barrier to production is floating money values. Let's be clear about what money is. This is not wealth. If you burned up every dollar ever produced in the world, the U.S. would still be the richest country on earth. We are its wealth. What we produce is the wealth. Money is used as a measure to facilitate the exchange of the wealth we produce. Adam Smith got it right long ago. The sole purpose of money is to facilitate the exchange of consumable goods. And so the way to think about money is the way you should think about what life would be like for a chef or a construction worker. If the size of a tablespoon or length of a foot or minute were changing all the time every day. If so, there'd be chaos in kitchens on the way to inedible food emerging from them, and there'd be leaning towers of Pisa around the world. But thankfully, all are standard measures. Historically, that's what money was. It was used to facilitate the exchange of the actual wealth we produced, along with investment in the wealth of the future. So when money's floating around in value, it's deprived of its singular purpose, which is as a measure. And then the fourth basic, and I leave it for last, simply because it's the simplest, but it's also the one that it trips up economists the most, is trade. Thinking about trade and looking out at all of you, I think it's fairly apparent that none of you cut your own hair. It looks like none of you make the clothes that you wear. You're eating here today, so you don't raise the food that you eat. You probably don't manufacture the computers that you type on. What you're signaling to me by that is that you are all free traders. You are ardent free traders. And so when governments put tariffs on foreign goods trying to reach the United States, they are taxing the reason that you're working in the first place. And that speaks to the beauty of free trade. It just means that you don't have your neighbors or people in your city, state, or country lining up to serve your needs. It means that you have the most talented people on earth getting in line, trying to figure out a way to give you a bargain, trying to stretch the value of your paycheck. But even that doesn't explain the true beauty of free trade. What makes it truly wondrous is that it maximizes the possibility that we as individuals will get to pursue the path in life that most animates our individual talents. Let's face it, when we can leave all the other stuff to others, we can focus on what we're good at. Everyone in this room is good at certain things, probably many things. You know what it feels like to be good at something. It's not work anymore. It's easy. And so that's why free trading nations tend to be very rich nations, because people, odds are doing work most commensurate with their talents. And so there you have the four basics to economic growth. If you just remove those barriers, you have abundant prosperity all the time. And to break it down into something even more simple, I'll bring up a quote from Henry Hazlitt's essential book, Economics in One Lesson. Now, in it, Hazlitt wrote, "What is harmful or disastrous to the individual must be equally harmful or disastrous to the collection of individuals that make up a nation." Now, think about that for a second. I would argue that that's the most powerful statement ever written in any economics book. What Hazlitt was saying was very, very basic, but it was also profound. It's something that if politicians and economists understood, we would be enjoying prosperity today that would make the abundant present. And let's face it, we live in a rich country. Look, it would make it look microscopic by comparison. All Hazlitt was saying is that an economy is not some living, breathing blob. It's just a collection of individuals. And so when you break an economy down to the individual, you can then see why prosperity is so simple. Because no individual is improved if half of his income is being taken away in taxes on an annual basis. No individual is made better off if more and more of that person's working hours are being taken up complying with rules as opposed to creating real wealth. No individual is improved if the paycheck that they're paid in comes in dollars that are constantly being devalued by the U.S. Treasury. No individual is made better off if certain parts of the world are walled off, whereby the talented in those parts of the world can't serve that individual's needs. And so you can see why prosperity is so simple. And then it works very well given what I'm going to discuss today. I want to talk about the Great Depression, the financial crisis, and the present economy, and to talk about it through this prism of the economy of the individual. And so when you think about that, if you talk to most economists today and ask them, what can we do to fix what's wrong, they generally focus on government spending. They say, we've got to get demand up in the economy, get government spending, that will get the economy moving again. Well, that fails in two very important ways. Once again, governments have no resources, so for them to spend, they must subtract them from entrepreneurs and businesses. Secondly, the last thing a government would ever want or need to do is stimulate demand. And the reason for that's simple. As individuals, we're wired to demand things. That's why you're at work every day. You've got infinite wants. But you can only demand insofar as you produce. And so the only way to stimulate demand in the economy is to remove the barriers to the supply side of it. Basically remove the tax, monetary, trade, and regulatory barriers to production. But if you look throughout history, times of major economic strife were times in which we erected those barriers, usually all four at the same time. Now, starting with the Great Depression, what needs to be stressed there is if you don't know what happened in 1920 and 1921, you do not understand the Great Depression. Whatever you think you've read, whatever you've read about the 1930s, whatever you heard from Ben Bernanke, it's all incomplete unless you know what happened in the early 20s. Well, back then, the U.S. economy contracted, and it did so substantially, far more than it did in 1929 and 30. But the reason you never hear about this downturn is because it was so short. And it was so short precisely because the federal government did less than nothing. Contrary to popular opinion today, which says governments must spend with abandon during times of hardship, back then federal spending was slashed from $6.4 billion in 1920 all the way to $3.3 billion in 1923. This was textbook perfect economics. Governments have no resources. When the economy is weak, leave them in the private sector where they can reach productive ideas. Also, contrary to popular opinion today, which says governments must devalue the currency during times of hardship, back then the dollar's integrity as 1/20th of an ounce of gold was maintained. This was important because while there are no companies and no jobs without investment first, investors, when they commit capital, are by definition buying future dollar income streams. And so the last thing you want to do is to devalue any potential returns. It will scare away the investors necessary for recovery. And so with government doing less than nothing, the U.S. economy took off. Unemployment was at 11.3% in 1920. It fell all the way to 1.7% in 1923, on the way to what we now know as the Roaring Twenties. So if there's one thing I hope you'll take from my talk today, and this is important, it's that despite what economists and politicians tell you, recessions are beautiful. Recessions are a sign of an economy on the mend, of an economy cleansing itself of all the misuses of labor, all the bad investments, all the bad business concepts of the globe.com and webvan variety, getting cleansed out. And that's why when recessions are left alone, they by definition lead to major economic rebounds, because the recessions are the signal of the cure taking place. Well, in 1929 and 30, the U.S. economy contracted again. It wasn't any big event, much smaller than the early 20s. The difference this time was that Presidents Hoover and Roosevelt decided to conduct a grand experiment on the American people. They were going to shield them from the near-term pain of recession. In doing so, they gave us what is now known as the Great Depression. Now I'll begin with some of Hoover's errors, and then I'll get to more of them when I talk about Roosevelt. But in response to the downturn, Hoover and Congress decided to double government spending. And then worried about the deficits that resulted from that, they increased the top tax rate from 25 to 62%. Their economic program failed miserably, and they were pushed out of office for FDR. But rather than learn from Hoover's mistakes, FDR doubled down on them and then added some of his own. First up is government spending once again. He got together with Congress, and they proposed a $7 billion deficit in 1934. Let me be clear, I don't care about deficits versus surpluses. To me, all government spending is deficit spending. But the idea there is they thought they could stimulate the economy by the government spending more. They failed miserably, and I think all of you know why. To believe that stimulus works, you'd have to believe that the left side of this room could go to the right side and steal $20 from each of the right. Well, of course, the left side would be stimulated, but the right would be commensurately depressed. Also left out of such a scenario is the crucial aspect of production. Stimulus spending merely rewards indolence, all the while penalizing enterprise. Beyond that, it goes back to the basic truth that John Boehner and Nancy Pelosi do not, nor could they ever, know how to allocate the economy's resources better than market-disciplined actors. Considering taxes, FDR raised the top rate from 62 all the way to 83%. This matters because in any economy anywhere in the world, we are always reliant on the vital few to power us forward. Yes, the much demonized 1%ers that politicians and economists don't want to be associated with. The Bill Gateses, the Jeff Bezoses, the Fred Smiths of FedEx, who take the risks on the new ideas that employ us, make us more productive, make us healthier, all that. Well, the vital few in the 1930s were fairly explicitly told, if you take a risk on a new idea, your reward will be expropriation of the vast majority of your income. Considering regulations, FDR and Hoover imposed all sorts of rules on businesses that would not allow them to lower the wages they were offering to new economic realities. The way to think about this is to think about a Walgreens or Rite Aid in town. When it's struggling to sell the toothpaste on its shelves, it lowers the price of that toothpaste to pull in buyers in order to clear the inventory. There was a massive backlog in the 1930s of willing workers, but regulations made it difficult for businesses to lower the prices to the level such that they could hire them. It basically became too expensive to hire workers. And then most of us know from our history books, if you took U.S. history, or if you're unlucky enough to do it about the 1930s, believe me, they mistaught you. But we remember that FDR created all sorts of make-work programs that paid Americans to do work of no economic value. Now, the obvious problem there is if you're getting $1 from the government, it's much more difficult to lure you back into productive work because it's more expensive. High unemployment is always and everywhere a creation of government simply because labor is a price like any other, and only government can keep labor's price from falling to its natural clearing level. Moving on to trade, and this is the most important, in 1929 and in 1930, Herbert Hoover signed into law the Smoot-Hawley tariff. This was easily Hoover's biggest mistake, and nothing else come close. The tariff put all sorts of taxes on myriad foreign goods trying to reach the United States. About this tariff, J.P. Morgan senior partner Thomas Lamont remarked, "I almost went down on my knees to beg Herbert Hoover to veto the asinine Smoot-Hawley tariff." GM's European head Graham Howard sent a telegram to Washington saying that passage of Smoot-Hawley would lead to the most severe depression ever experienced. If you want to crash an economy, one of the quickest ways to do it is to put up barriers to foreign goods. And I think most of us can see why this is so obvious. Let's face it, if foreigners can't buy from us, it's kind of hard for us to sell to them. And so Hoover needlessly shrank global markets for U.S. producers. But beyond that, we have to go back to basic economic principles. I know for me, if I were told that I had to manufacture the computer I type on, raise the food I eat, make the clothes I wear, and put a shelter over my head, I would very quickly die an unemployed, unclothed, unfed, unsheltered death. But thanks to free trade, I don't have to worry about that stuff. I leave it to others and I focus on what I'm good at. Tariffs, as a rule, force us into work that we're not as good at. They also subsidize the best businesses, the worst businesses at the expense of the most productive ones. In a modern sense, Apple would never want tariffs on foreign goods simply because Apple wants to sell to the global markets. And then, of course, in order for businesses to expand, they need to attract investment. Investors are once again buying future dollars when they commit capital. But in 1933, FDR devalued the dollar from 1/20th of an ounce of gold to 1/35th of an ounce of gold. This sent a very chilling message to investors that if you commit the capital to new ideas and you're lucky enough to actually get a return, they will come back in devalued dollars. The very investors necessary for recovery were chilled out of the market altogether. And then maybe most economically crippling of all, FDR signed into law in 1936 the undistributed profits tax. This taxed businesses at rates up to 74% on any earnings they retained. So if you were GE, GM, Ford, and RCA, four major U.S. companies at the time, and you had the temerity to retain some of your earnings with future expansion in mind, a factory, hiring, maybe just a future rainy day, the government lay in wait to expropriate the vast majority of it to give it to someone else. The way to look at this is to consider Henry Ford. He incorporated Ford Motor Company in 1903, but it's not as though cars started rolling off the assembly lines the first day. Henry Ford was able to perfect a still unproven way of producing cars through feverish reinvestment of his very limited profits back into the business. If he had started it in 1936, odds are it doesn't become the great global brand that it did simply because he wouldn't have been able to access the means to grow the business. And so when people ask about the Great Depression, there's really no mystery surrounding it. It's fairly basic. It wasn't caused by capitalism. It was caused by a rush away from capitalism. The four basics were violated. Taxes went through the roof. Regulations did too. Trade was made less free, and the dollar was devalued. Beyond that, the political class in its infinite unwisdom forgot the important lesson of the early 20s that recessions are very healthy. In meddling with it, they extended it. Now, many like to ask what caused the end of the Great Depression. If you talk to members of the economics profession, they'll almost to a man and woman tell you that what ended it was World War II. I can't think of a more horrifically obtuse indictment of this profession than what is so demonstrably untrue. World War II did not end the Great Depression. What ended it was that by 1938, the New Deal, for all intents and purposes, was over with. And it was over with because it had failed miserably in the eyes of both Republicans and Democrats in Washington. The argument made by economists is that government spending on the hiring of troops and armaments got the economy moving again, but that is typical for economists, 100% backwards. Remember, governments have no resources to spend. They only had the resources to spend insofar as the New Deal's end meant that the productive economy that provides those resources was moving again, such that the federal government had the resources to fight the war. Beyond that, to believe that World War II ended the Great Depression, you'd have to believe that you could grow your economy by killing your best customers around the world. To believe that it ended the Great Depression, you'd have to believe that the very human beings who author all advancement somehow don't matter, that we're better off if we send them overseas so that they can be maimed and murdered, that would be more stimulative than keeping them at home. To believe that it ended the Great Depression is to turn Adam Smith's proverbial pin factory on its head, whereby the division of labor naturally leads to more production. The Keynesian World War II argument says, in fact, that countries were better off walling themselves off to one another and then producing armaments meant to destroy people and lives and wealth around the world. To believe that World War II ended the Great Depression is to believe that with the U.S. economy still relatively weak, that we should dynamite a few American cities and pay Americans to rebuild all the wealth and lives destroyed, and maybe find a few more wars to fight so that we can send our best and brightest overseas so that they too can get murdered and maimed by the guns of others. To believe that World War II ended the Great Depression is to believe that once the war ended and federal spending fell substantially, that the U.S. economy fell into the mother of all Great Depressions. Well, in fact, it soared after the war, and by nature it did. Instead of having our best and brightest overseas getting killed and being killed, they were at home once again, producing for and alongside their fellow man, and the U.S. economy took off. There's not a more dangerous myth inside the economics profession today, and it's full of them, than this view that killing in war is somehow stimulative. And I think it's incumbent upon all of us to fix what is so misstated. Now, moving on to the financial crisis, I think it's worth talking about because a lot of mythology surrounds it too. What most people, I think, would agree with is that housing had something to do with what took place in 2008. But from there, the mythology begins. What needs to be stressed up front is that housing is not investment. When you buy a house, your purchase of it is not going to make you more productive. It's not going to lead to cancer cures that elongate lives. It's not going to lead to software innovations that make us more productive. It's not going to open up foreign markets to us. Housing is consumption. So when it started to boom in the early 2000s, this was a very negative economic signal that the productive parts of the economy were suffering a capital deficit as investment flowed into consumption. And so the question then becomes, what caused this slow growth rush into housing? Well, to hear the left in the United States, it was caused by deregulation of the banks. They like to argue that banks suddenly lacked the adult supervision of regulation and as a result made a lot of dumb loans to people who could not pay them back. Now, the obvious problem with such a point of view is that the banks were never deregulated. Banking remains the most regulated sector in the U.S. economy. Furthermore, as the regulators themselves actively encouraging these banks to make loans that made no sense. So the deregulation argument is just silly. It's popular on the right to first of all argue that Alan Greenspan's Fed caused the housing boom. They argue that he cut the funds rate to 1% in 2001 or 2002 and kept it there for a year. This made credit easy on the way to a housing boom. To believe this, you'd have to believe that the Fed is the only entity on earth capable of decreeing an artificially low price on the way to abundance of what it's trying to make abundant. But logic dictates the Fed can't do that. Credit is not money. Credit is access to the economy's resources, desks, chairs, buildings, computers, labor. The idea that a central bank could decree it cheap is laughable. Secondly, the low interest rate argument ignores something very basic about price controls in a more broad sense. Imagine if the mayor of Los Angeles, unhappy with the prices of apartments, were to decree them artificially cheap, let's just say $100 a month. Well, demand for apartments would be very high, but I don't think anyone would seriously say supply would surge alongside it. But what's most important is that this argument ignores basic U.S. economic history. What's too often forgotten is that the Fed jacked up rates throughout the 1970s, but during that time, housing was easily the top asset class in the United States. In George Gilder's 1981 book, Wealth and Poverty, he talked about the Jimmy Carter housing boom from the late 70s, and this is how he described it. What happened was that citizens speculated on their homes. Not only did their houses tend to rise in value about 20% faster than the price index, But with their small equity exposure, they could gain higher percentage returns than all but the most phenomenally lucky of shareholders. Gilder was writing about the high rate 1970s, but if I'd said he'd written this in 2006, I don't think anyone would have batted an eye. Furthermore, the rate argument ignores that housing boomed around the world, in parts of the world where central banks had rates quite a bit higher. It's also popular on the right to blame Fannie Mae, Freddie Mac, the mortgage interest deduction, and the Community Reinvestment Act for causing people to consume more housing. Let me be clear, I would like to abolish all four yesterday. I think it's anti-freedom and logically anti-growth for a government to stimulate consumption of a good that has nothing to do with growth. But the problem with that argument is that it ignores that housing boomed in countries like Canada, where it was very difficult to attain a home loan. In England, where they got rid of the mortgage deduction back in the 1980s, and in countries around the world that have no such thing as Fannie Mae and Freddie Mac. What caused the slow growth rush into housing was the Bush Treasury's decision from early on to pursue a cheap dollar, a weakened dollar. Presidents always get the dollar they want, and if you look throughout history, when currencies are devalued, there's always and everywhere a rush into the hard assets least vulnerable to that currency's devaluation. The great thing about housing is it's something you can live in, so it's a wonderful hedge for people trying to protect their wealth from the monetary authorities' evisceration of it. And that's, of course, why the housing boom was so global. When we devalue in the United States, it's always everywhere a global event. The world is still on a dollar standard. Countries either have their currencies explicitly pegged to the dollar, and if they don't have that, their currencies generally follow the dollar's direction. So with currencies around the world in decline, housing was the logical beneficiary, and it was a slow growth event for the world. So the question then, people like to then ask, or they assert that the financial crisis was rooted in a slowdown or a moderation of this rush into housing consumption. But logic dictates that's not the case, and we know why. The housing boom was inimical to economic growth, and so anything that was going to reverse it could never cause a financial crisis. Others like to point to failure among banks and investment banks, and they say that caused the crisis. But as we know, any capitalist system is defined by failure. Failure is a healthy signal of a capitalist system constantly fixing itself. So the idea that you could cause a crisis that's financial in that sector by a few banks getting in trouble is not a serious argument. What caused the financial crisis was the Bush administration and Bernanke Fed's horrid decision to bail out Bear Stearns in the spring of 2008. And the reason this was such a big deal is that it created the assumption in the marketplace that all financial institutions were going to be saved by the federal government. People like to argue that Lehman Brothers, the correct decision to not bail it out, caused a crisis, but can we be serious? The notion that Lehman Brothers could shake global markets in any substantial way is not a serious one. No bank could do that. The reason Lehman was such a crisis for the markets is the Bush administration and Bernanke Fed created the assumption that Lehman too was going to be saved. And so when it wasn't saved, they created a needless panic. But think about if Bear isn't saved altogether. Lehman probably dies the next week, and it's a very orderly death for it. Instead, the Bush administration intervened, and they created a market panic. Having done this, they then decided to pour gasoline on the proverbial fire. Specifically, they banned short selling in 900 different financial stocks. You can't make this up for the sheer ineptitude of what went on back in 2008. We have a crisis in finance, and we want to drive away an essential source to market pricing, specifically market skeptics, the people skeptical about the prices of certain shares. Who on earth would then go long a stock if they know that the bearish point of view is not reflected in the price? And so in driving away the short sellers, the Bush administration also drove away buyers. Also forgotten by these people is that short sellers are by definition buyers themselves. In order for them to take profits, they must eventually re-enter the marketplace and buy back the shares they initially sold short. So when we allow them to work their magic, a massive reserve of buying power is created that puts a floor under markets that are falling downward. But the Bush administration, in its infinite unwisdom, decided to ban short sellers when we needed them most. And then I would argue that the biggest driver of the financial crisis, but the one that's not talked about enough, is something far more basic. Going up to 2008, in the 30 years before that, free markets had won, and they had won big. No serious person any longer argued that somehow government meddling in the economy was good for it, that somehow a more muscular government presence somehow helped the economy. And so really the bailouts themselves were the biggest driver of the market panic for what they signaled about the future. Bailouts are not free. When you take money from government, you are no longer in the business of profit. Instead, you're serving political masters who don't care about profits, but who have a strong opinion about how your business will be run, whom you're going to hire, how many you'll hire, how much risk you can take on, what business lines you can get into. The bailouts prefigured much more muscular global government involvement in the U.S. in the world economy. And investors aren't stupid. They're pricing in the future. They look back to the 20th century. It didn't work out too well then. I don't think any presumed we would go back to the disaster that was the 20th century. But certainly the bailouts signaled that that governments around the world were going to have a much greater involvement in the economy, and that never works well, and investors panicked. What needs to be stressed about this is none of what I've described has anything to do with capitalism. It has everything to do with a rush away from capitalism. It has everything to do with a crisis that was wholly man-made. The markets themselves could never cause a financial crisis simply because there's a buyer and seller beyond every trade. This was a creation of the political class by definition. Now, the argument made in favor of the bailouts was the Ben Bernanke one. He, in grave tones, told Nancy Pelosi that I spent my life studying Great Depressions, and if you don't bail out these banks, you're going to have the mother of all Great Depressions on your hands, one that will last decades and that will make the 1930s look like child's play. Now let's think about what Ben Bernanke said, and let's think about it in terms of something we're all familiar with, Japan in the aftermath of World War II. Japan was literally leveled by the war. 2 cities taken out by nuclear bombs, the rest completely destroyed. Most economically crippling of all, Japan lost at least a generation or 2 of its best and brightest to what I would argue is a needless war. But within a few years of the war's end, Japan's economy was booming again. Adopting the 4 basics to prosperity that I describe in the book, Japan was one of the richest countries in the world again. So was Germany, despite the fact that many of its people were living in caves after the war. And so I'll just ask the question, if Japan and Germany could come back from the utter devastation that was World War II within a few years, is it remotely credible, as Ben Bernanke so confidently asserted, that the U.S. economy could not survive the failure of a bank or a number of banks, most notably Citi, a bank that's been bailed out 5 times in the last 25 years by the Federal Reserve? I think the very nature of my question answers it. Not only was Ben Bernanke incorrect, but you could argue that he was criminally inept, considering what he did in concert with the Bush administration and the House of Representatives back in 2008. And so when you're trying to understand the present economy, it's hard to separate what took place in 2008 from the present. The economy was desperately in need of a major cleansing back in 2008, but the political class robbed it of it. What's got to be remembered is that failure in a capitalist system is a sign of health. Failure tells entrepreneurs what not to do next. It's the way that we starve bad managers of capital so that good ones can receive it. It's the way that we starve bad businesses of capital so that good ones can receive it in abundance. Silicon Valley is not the richest region in the U.S., if not the world, because all of its businesses succeed. Silicon Valley is the richest precisely because the vast majority of its startups fail. Through failure, you get perfection. It's the only way to evolve. Rich places are marked by constant failure. And that's what stresses the importance of allowing Wall Street and banks to fail too. I am one of these homers who loves everything about Wall Street. I believe everything that Lloyd Blankfein says about Wall Street's purpose in the economy. I buy into Joseph Schumpeter's every word about how investment bankers are capitalists par excellence. They are doing the most difficult job of all. It's one thing to come up with an interesting idea. It's quite another to get funding for it. What Wall Street does is brilliant. And that's why the bailouts were such a horror, were such a disaster for Wall Street. because they robbed an essential source of innovative finance of the necessary evolution that would have come from failure. And we know this intimately right now. Morgan Stanley's CEO acknowledged in 2013 that his company's #1 client is the federal government. Is it any wonder then that the U.S. economy is a bit weaker today when we consider such innovative sources of finance owe their existence to the federal government, as opposed to spending all their time finding capital for the businesses of the future? Considering unemployment, it's relatively high today for the same reason it was in the 1930s. Politicians are not allowing the price of labor to adjust to new realities. We can see it in many ways, but whatever you think about Obamacare, what you cannot deny is that it's making it more expensive for businesses to hire workers. Considering unemployment benefits of 99 weeks, let's face it, incentives matter. If you know you're getting money from the federal government no matter what, you may be less likely to look for a job on a day when you're not feeling well, when it's raining out, or for that matter, when it's sunny out. You can be more choosy. Every dollar that someone gets from the government makes it more expensive for businesses to hire them. And then there's the 4 basic governmental barriers to production. Unsurprisingly, they've all been violated in modern times. In 2012, President Obama signed into law tax increases on income and capital gains. In doing so, he raised the price of work, and he also raised the price of investment in the work of the future. Considering regulation, in 2002, President Bush zestily signed into law the Sarbanes-Oxley Act. This act turned entrepreneurial CEOs into criminals who risked prison if they signed an incorrect income statement. Obama, in his case, he's tried to re-regulate healthcare, finance, the energy sector. None of this is going to work. By definition, it cannot work, but it's forcing businesses to spend more and more time complying with the rules rather than creating profits. Considering trade, Bush and Obama oversaw tariffs on steel, softwood lumber, shrimp, Chinese tires. Thinking about China alone, it would be hard to find a happier story in modern times than the story of China. Here, this formerly desperately poor country has chosen to embrace the profit motive. It's been wonderful, but think about what it's been for the United States. It's been beautiful for the United States. Every day that the Chinese get up and go to work, Americans get a massive raise. Even better, the Chinese make for us the shoes, socks, and t-shirts that if we made, we'd be poor. Instead, we leave it to them, and that gives us time to create Google, Intel, and Microsoft. If China didn't exist, we'd have to invent it. But rather than embrace this great story, we've had 2 successive presidential administrations demonize it. Most shamefully, the Bush administration demonizing what a special thing was happening and continues to happen in China. All of which brings us to the dollar, and you can't separate anti-trade talk from the dollar. When Bush got into office in 2001, a dollar bought 1/260th of an ounce of gold. By 2011, under President Obama, a dollar bought 1/1900th of an ounce of gold. Right now, it buys roughly 1/1100th of an ounce. This cannot be minimized. Once again, when investors invest, they are buying dollars in the future. And so, under 2 successive presidential administrations, the very investors necessary for economic rebirth, for investment in the companies of the future, have been fairly explicitly told, commit capital at your peril, because if you actually get a return, it's going to come back in greatly devalued dollars. If you gave me one policy lever to fix the U.S. economy, it would be to stabilize and strengthen the dollar. Nothing else comes close. All of which brings us to Ben Bernanke, our mercifully departed former Fed chairman. I can't think of a bigger individual indictment of an economics profession that borders on palm reading than Ben Bernanke. Whatever you think of the Federal Reserve, whether it should exist or not, it's a different discussion. The last thing any serious economist would ever do is lower the price of whatever rate that person's trying to set to 0. That is the juvenile equivalent of the mayor of Los Angeles saying, you know, apartment rents are too expensive, so I'm going to lower them to $100 a month. At best, the Fed succeeded in making credit less plentiful, not more plentiful. Quantitative easing, let's just call it what it is. Let's call it the monetary policy for the child, for the really immature adolescent. What serious person would believe that you could get economic growth and more Intels and Microsofts by virtue of a central bank borrowing $4 trillion from banks and proceeding to presume to invest it? What would they know about investing? Even more amazing is what they invested in. They proceeded to buy U.S. treasuries and then proceeded to prop up the mortgage market. Oh yeah, the mortgage market, the housing market that caused us so many problems to begin with, they decided to double down. You cannot make up the sheer ineptitude of Ben Bernanke, and that's why when people tie the present rally to quantitative easing, I shudder. The idea that those guys would know how to engineer a rally, the idea that quantitative easing could cause stocks to go up, I don't find credible. But maybe the biggest indictment of Bernanke concerns the sheer hubris within such a mediocre thinker to say that he alone should use the power of the Fed to shield Americans from the near-term pain of recession. Now think about that. Recessions are healthy. In doing what he did, in meddling with what was healthy, Bernanke robbed the American people of a major economic rebound. He is said by people who should know better that he's the world's foremost expert on the Great Depression, but all you have to do is look at his actions since 2008 to realize he learned all the wrong lessons from the 1930s. Now, despite all that, I do want to end on a positive note because I am, as you know from the beginning of my talk, and I'm an incurable optimist. I think we're living in the greatest country on earth. And what's interesting about a country so full of energetic immigrants that like we are is we get stupid once a generation. We're so focused on the good, important things in life that once a generation we get dumb. We did it in the 30s, we did it in the 70s, we've done it more recently. We're going to rebound, and we're seeing it right now. President Obama's presidency ended for all intents and purposes in 2012. I'd say the same thing if you're a Republican. Obamacare is failing before our eyes, and it steeled the electorate to say we don't trust anything more of the big government for us. That's going to last for quite a while. We're just not going to trust these guys again for a long time. Bernanke's out at the Fed. That's a big deal. Janet Yellen believes all the same poison. The difference is she will not have the power that he did to do so much damage, simply because there's no longer consensus inside the Fed about the good of quantitative easing. Thank goodness. And then after all that, we have to remember the electorate is smart. If markets are smart, so is the electorate. The electorate realizes the danger of these two political parties, and they voted gridlock. They've said, we don't trust either of you as far as we can throw you. And so through gridlock, the real people who power the economy forward are getting the chance to do it again. The economy is going to start moving again. It's a shame what we went through. But let's be clear, this had nothing to do with Americans running out of idea or initiative, and it had everything to do with government erecting barriers to the four basic ways to prosperity. Thank you very much. I guess you're all convinced at that point, so there's no need to. But if, oh, in the back.
So since you think that the recession didn't have its proper cleansing from the last time, do you foresee that poison building up and an even worse situation occurring in the near future?
Yeah, there's talk about that. Let's face it. Yeah, we never got to cleanse out the bad stuff. And when you mess with nature, you get something much worse down the line. My honest guess, though, is that we're already living it. The lack of cleansing was this slower economic recovery. So this is the pain right now. What we should be experiencing right now is the mother of all economic rebounds. I like to point out that if President Obama had gotten the White House and said, you know what, I'm unequal to these problems, I'm going to go play golf for 4 years, he would be the most popular president of modern American history. Because really that's all you need. And let's stress that I'd say the same about recessions are the cure. So just get out of the way and let them run their course. And so I think we've already suffered what you describe in terms of a much slower economic rebound, and who knows what we lost in the process, major advances that would make the present look kind of small by comparison.
Do you see any role for government?
Absolutely. I see tons of role for government. I just don't see much of a role for the federal government. The founders were libertarians. I'm a crazy libertarian, I admit it. The founders were very explicit. The U.S. was a unique experiment. They said, we are going to build a country based on the idea, based on skepticism about politicians. And so they wrote a very clear document that said the federal government has very few powers. Basically, the document was written to protect our powers to live as we want. The Constitution was written to make sure that our rights were protected. Having said that, 13 states, 13 laboratories, Some people were going to want a lot of government, and thumbs up to that. You choose your bliss on the state or city level. That's where you should pay your taxes. If you want lots of parks and trees and pools, I have no trouble with that, but you choose that on a local level. Federal government is there to protect our rights. The states, that's where you can choose a lot or very little government. So I don't think, I'm all for government. I'm not against public schools as an example. I just think it should be local, and that's what the founders believed. It's a shame that we all have to pay such high federal taxes. It should be local.
Personally, I'd like to say your book is wonderful. I highly recommend it to everyone.
Thank you.
One of the policies you weigh in on is the estate tax, and I think you're critical, to say the least. But other people, for example, Warren Buffett, have argued that there might be a role for, not for the socialist ideal of transferring wealth, but you believe that the government would only squander that money. But in the case, for example, and you mentioned in your book Paris Hilton, she's not a great steward of resources. I think everyone would agree with that. What's the harm in taking her money away and giving it to someone to go to get a college education that they couldn't otherwise afford?
Well, you know this from reading the book, but that's the beauty of letting them hold on to it. Because let's face it, when the rich get to hold on to their wealth, we have immediate access. Paris Hilton, unless she is literally stuffing the wealth under a mattress, if she puts it in the bank, they're not paying her for a deposit so that they can stare at them lovingly and say, look, those are Paris Hilton's dollars over there. No, they're lending them out to people who need a car loan, who need college tuition, who need a small business loan. Stock market, her wealth gets to companies needing to grow. If it's private equity or venture capital, it's getting to companies on their deathbed, or a future Microsoft or Intel. And so I'm all for redistributing the wealth. I just want the markets to do it. And so when we allow the rich to hold on to it, it has this brilliant impact on the economy because it's redistributed in market discipline style. Thinking about it in terms of the estate tax, what an anti-growth tax. Now, the example I use in my book is ESPN. It's not often known that ESPN nearly died in 1980. It was a pathetic joke of a company with headquarters a fraction of the size of this room. Thank goodness for the Getty Oil Trust in California. They invested $10 million in it, and the rest is history. Now, that was based on the estate that John Paul Getty left behind in 1976. Now, people will respond. They'll say, well, but the Getty's $10 million was nothing to them. They could have found that at one of the estates, and that's the point. You make my point for me when you say we should break up these big estates because they've got so much. The Gettys had $10 million to lose. If I lose $10,000, I'm in trouble. They had $10 million to invest on something that the average person, your average client, you can't put their money in a lot of these risky ventures. Because let's face it, Silicon Valley, most of those businesses die, and that's why Silicon Valley was a venture creation of old money East Coast families. They had so much money they were willing to lose it on these. So it's Vanderbilt, Rockefellers, Phipps, those kind of families. They were the money behind Silicon Valley. They had so much they were willing to lose it. The Gettys were willing to lose $10 million. And so when you tax away the wealth of the super rich, you're taxing away the most crucial wealth of all. The money that's not going into wealth preservation strategies, but going into those really interesting ideas that if they succeed, wow, but odds are they're going to die. And so society loses essential risk capital when we go after the super rich because they, once again, can lose it. And we need that. Economic growth is built on surprise, these interesting ideas that can only be funded by the super rich.
One more question with respect to the question of is America in decline? One of the other capitalists you mentioned is Henry Ford, who had no trouble at the turn of the century finding, say, 12,000 people who knew how to use a wrench.
Mm-hmm.
But what about the Henry Fords today who need 12,000 people with engineering degrees or some other scientific background that is becoming increasingly scarce?
I don't worry about that. Market signals are good. If there really were a scarcity of engineers, it would show up an enormous pay for engineers. Now, engineers are paid well out of college, but you should. Market signals fix that all the time. The last thing you want is for government to subsidize. Well, we want more engineers. What could Hillary Clinton possibly, and probably Jeb Bush says the same thing, what could they possibly know about the market's needs? You know, 20 years ago, could anyone in this room have predicted all the people employed in internet? Oh, so because as of now, there would have been a scarcity of internet workers 20 years ago. But you know, you look at that, people adjust. They go to where the money is. I don't see the difference with engineering. Nowadays, a software engineer in Southern California can actively work alongside one in Shanghai. And so they can literally look at each other as they work. And so I don't buy the scarcity argument when it comes to engineers. If in fact it's true, it will show up in pay, and that will eventually be worked out. Equilibrium will be achieved.
So I definitely identify with your perspective that with regard to a recession, sort of stepping back and taking the pain can be the best medicine. But if now we're paying a price of a reduced economic rate of recovery for a lower rate of decline at the time, is that not to some extent a fair trade, since the government has sort of reduced the volatility of that period?
I don't think that's a fair trade. I certainly don't think, because there are a lot of people still suffering the unwillingness of the government to get out of the way. Would you prefer the Roaring 20s, or would you prefer the 1930s? I'm not saying that they're the same, but there are so many tight correlations between what the political class did in the 1930s and what it's done nowadays. I don't think it's fair to the American people for politicians who wouldn't have a clue about prosperity imposing on, and who don't suffer a downturn. Believe me, I live in Washington, D.C. You guys have built us a beautiful city over the last 10, 15 years. Trust me, you know where that stimulus money went to Washington, D.C. I don't like the idea of the political class building monuments to itself and building itself a nice city while the rest of the country suffers in a relative sense. It would have been a short decline, and we'd be much better off as a result. And it should be stressed that Warren Buffett could be a senator, and he would be a terrible investor. The importance of being an investor is failure. Again, Silicon Valley is built on most of these ideas dying, of them being starved of capital. The problem with government investment is not ideology. It's not political party. It's not as though Rand Paul would be a good investor. He'd be awful at it. And the reason for it, government doesn't kill its darlings. Whereas in the private sector, bad ideas die all the time. With government, they last forever. And so you think about what we've lost. I think it's fair to say that we probably would have already licked cancer if not for all these government barriers to our prosperity, these many decades, all that spending, taking experimental Getty oil type money out of the economy. Think about what we've lost in terms of transportation. We'd already all own private jets by now. I think that's a fair assessment. I think it's fair to say that future generations, that's all they'll know is private jets, but we were delayed on that. We probably have something that would make the internet look quaint. You need that constant leaping, that constant investment in interesting ideas. Most of them are going to fail, and that's the point. We've been robbed of that because government's doing so much. So that's a bad trade-off to me.
Despite our many shortcomings, is there a country that does it better than us? And I guess my follow-up question would be, is there a way to put that toothpaste back in the bottle? Since government has grown so much, can you go back? Would it take a dynamic leader? Would it take re-education? Because we're already here, right, for the size of government.
Mm-hmm.
How do you propose to?
We bring a good question. Mirjam probably knows my answer on this, but I think I put Switzerland up there as one of the countries that really does it well. They kind of get it. But we still do it really well. We just get stupid once a generation. And can we put it back in the bottle? I think we can, but we're doing it the wrong way. I don't understand the people who constantly talk about how bad things are. Now, you just heard a very negative speech, but I'm telling I was optimistic at the beginning and end, and I am. Government is an ineptitude, but instead of talking about it, we've got to get that spending down. Talk about it in terms of, think of all the exciting investments in cancer research that will take place. Think about those private jets that are soon going to cost $100,000 that will roll off the assembly lines if government's consuming less. Think about all the interesting jobs we'd have. Who among you, not you, but just in the populace, would prefer a government job to something really interesting at Google? And so we've got to talk about what could be instead of how bad things are. We live in a great country. I mean, people around the rest of the world, they see how we live, even the poorest, and they're staggered by it. But we could just, the shame is, and the conversation should be, think how much better we'd be doing if not for all these barriers. We're performing at a fraction of our potential, and that's what's unfortunate. But let's talk about what could be, not about, oh, well, those deficits are going to get us someday. I've been hearing that all my life. I don't buy it. It doesn't scare me. You know, rich countries can run deficits. To me, all government spending is deficit spending. Governments are spending what we created in the first place. And so I think deficit talk and all that about how we're going to be Greece is a head fake, and it's a waste of time. Talk about what could be, not about these little things. Back.
So all this talk of income gap being such a huge problem, would you say will also be solved if we didn't have government?
I would, in fact, argue that the income gap would grow if we had less government, and it would be beautiful. Let's start with the basic question. Would any of you be worse off if you got to pursue the path in life that most animated your talents? Would any of you be worse off if you were if you were pursuing that which would make you most unequal relative to others? I'm guessing most of you would raise your hand and say that yes, you'd be worse off if you had to pursue something in life that had nothing to do with your skills. Income inequality is beautiful. It just means that people are getting to pursue what makes them individually great. Now let's think about that. And so I think it's most of us in life, we naturally gravitate, and it's particularly great in a rich country like ours, we have the best opportunity to pursue what makes us individually great. So morally, I think we should encourage people to do that, but that's almost not the point. For the purposes of your question, look what happens when the income gap rises or the wealth gap rises. That's the surest sign that the lifestyle gap between the rich and poor is shrinking. If you want to see how the middle class and rich and poor of today will live, in the future, the best indicator of it is to go to Beverly Hills or name your rich area. That's the greatest signal of how we'll all live in the future if there's less government. Because how do you get rich in a capitalist society? You take what only the rich enjoy and make it broadly available to everyone. The original cell phone from Motorola in '83, brick size, bad reception, couldn't call anywhere, $3,995. I was in a McDonald's recently watching a teenage girl interview for a job. The manager goes behind the counter, and she picks up a phone that has internet on it, has email on it. That would have been a supercomputer 10 years ago. She owns it for next to nothing. Cars used to be the preserve of the rich. If you owned a car in 1900, you were a rich person. Well, Henry Ford made them broadly available to everyone. The computer, IBM makes the first mainframe in the 1960s, filled a room roughly half this size, intensely slow, over $1 million. When Michael Dell got really rich doing that, making computers broadly available to people. How many people in this room own an Apple product? Okay, Steve Jobs died worth billions. Michael Dell's worth billions. Jeff Bezos is worth billions. Would anyone in this room tell me that they wish that those three had just been layabouts? Because certainly societal inequality would be less. Most of us would probably say we want 100 each. But the only way you can get to that point is to remove all those barriers to capital finding the talented. So I would argue, and this is why I'm bothered when people allegedly on my side say, Obama's causing inequality, or Bush caused inequality. Please, inequality is a good thing. Rich societies are defined by it, and everyone's better off because they have the best odds of getting to do what they're great at. God, I want a lot more inequality because, see, I'm not rich, and so I want 100 of each of those guys to make my life easier, to shrink the gap between what the rich enjoy and what everyone else does.
It feels to me, and I agree with you, the politics of envy out there is just so strong.
It's
Like what you're saying makes sense, but so many people
true.
be able to get that message out to more people.
They mostly say it, though, during times of recession. They don't say, the electorate was pretty happy during the 80s and 90s when we didn't have all these barriers. You know, there was lots of complaints. Let's face it. Again, I hate both parties, but let's face it, when a Republican's in office and there's prosperity, suddenly the homeless are everywhere. When it's the Democrats, not as much. Okay, fine, you know, but the electorate was generally happy. And no, I hear your point, and I think we need to make this argument better that why are people rich today? I mean, I look at USC, you know, Pete Carroll made $5 million a year or something. God, what he did for that school. The billions that have flowed into USC. It was a safety school when I was growing up here and applying to colleges. Now it's impossible to get into. All these of one man. Was USC weakened by that inequality? Was UCLA weakened by John Wooden? I mean, you search for genius. The problem with Bangladesh and some of these other countries, they don't have these vital few. I hear you. Probably envy is an outgrowth of this, but let's take it. Let's take it any day of the week for what it could mean. You want the productive to be matched with capital. Okay.
More questions?
Well, thank you very much.